What do wealth managers have to think about when it comes to allocating private equity to their wealth management clients? I'm here with Steve Biggs, Managing Director and Head of Alternatives at the Mather Group. Steve, can you share with us a little bit about just what is your due diligence process? Because private equity is a lot different than the standard fund manager.
Right. I think private equity allocations for wealth managers are quite a bit different than institutions, right? So the evergreen product, like it or not, is here to stay. And we've seen actually evolution in the structures beyond that kind of late stage secondary design for the mass affluent all the way up into direct investments from individual managers designed for larger clients who would otherwise do closed end funds. But it does add another layer of the due diligence process, right? So in addition to investment philosophy, people, process that you would look at for a traditional manager, on the investment side, you also need to think of things about valuation policies, right? Do we feel comfortable that we're at least getting a reasonable valuation if we're buying into an existing portfolio? Certainly key concern. Another one is allocation policies, right? So how does a manager allocate to an evergreen fund versus a traditional drawdown fund, or are they managing portfolios for other institutions that they're allocating to? We need to feel comfortable that we're getting all the good ideas, the best ideas that manager has to offer.
Yeah, and I'm sure liquidity is probably a big key in all of this as well. Can you tell me a little bit about that?
Yeah, liquidity management obviously is a key concern because these are semi-liquid products, right? So, and it ranges everywhere from a interval fund that requires 5% a year to things that are possibly 5% per quarter. And now you're starting to see something with a little bit less, maybe 2.5%. So I think larger clients do have the ability to lock up capital for a longer period, but still 10 years possibly plus, especially if you get to venture, is a big ask because individuals just don't have the visibility into their liabilities that that an endowment or a pension does, for example.
That makes sense. And when you're talking to your clients about private equity, what message resonates most with them?
I think clients realize that we in the institutional world obviously have known for years that the public markets are shrinking, but that's starting to resonate with clients, and they actually like the thought of the diversification in addition to just trying to present a return story, but the diversification into smaller companies. And a lot of our clients work for private equity-backed firms, or they use products that say Databricks. It's still a private company. They want to know how to own this, and the only answer is through the private markets. So I think that part of it is starting to resonate and actually register with individuals more than it has in the past.
Fantastic. Well, tomorrow you're going to be on our panel specifically about how RIAs are allocating to private equity. So I really look forward to seeing you speak tomorrow. Thanks, Steve.
Well, great. Thank you, and looking forward to it.
And we're live at Private Equity San Francisco.